Good afternoon, people. Happy Friday. Welcome back to LSBF TV, here dedicated to our AAT community. In this session, you're going to be with me, Joel Romaner, and I'm going to be working through task number 4 of the business tax assessment, based upon the Finance Act in 2016. So brace yourselves, sit back, take note. Let's work through the task. So here we have business tax, week 4, assessment task 4. You're given a piece of information, a table of information here. This table represents a company called Destin Limited, and it's provided to you to complete your corporation tax return for the year ending the 31st of December 2016. And you're being asked in this task to complete the relevant boxes of the following extract. So it's not the entire thing, it's an extract of their corporation tax return for this year just ended. Now, guys, this assessment task is fairly broad and won't necessarily be upon the information that you see here. This is just a snapshot of what it could be like. And the examiner has said to us that whilst it's so broad, you've got to be aware of the specifics. Now, let's give you the big picture, which I'm sure you're all very much aware of. But our corporation tax computation to establish the amount of tax that must be paid, we'll look at the big four sources of income, of which we have our trading income, our income from our ordinary activities. Next, we'd have any interest income, interest that has been generated from any investments that we may well have. Third, any income that we generate from our property. So property income. Maybe we've got a surplus office building that we're renting out and we're generating income for ourselves. And finally, we would be looking at our chargeable gains. Chargeable gains on any capital, for instance, that we may have sold. And subsequently, we would take these figures, we would add them together, and we would get a subtotal from which we would deduct any charitable donations. And that would leave us with our TTP, our total taxable profits. Now, in task 4, you are required to undertake the administrative assessment, which you may well be doing in your day-to-day work jobs. And here, you will be taking information from the records of a particular business, and you will be placing them in this online HMRC document to ensure that we correctly calculate what is chargeable under the TTP. Now, the examiner has said that some of the most common errors, because as I say, you have to be prepared and aware of each input that relates to each of these items. And the examiner has said, so for your awareness, that the errors that arise centers around the following. We find that the private use adjustment is inaccurate. Now, here, the private use adjustment is for where within the business, one of our employees or one of the partners is using an asset such as a vehicle for their own direct use, or a computer for their own direct use. And we've got to disallow that from the allowable expenditure because it is not to be used in the computation of the company's trading profits. Another error that occurs is failure to recognize depreciation. That depreciation is not an allowable expense. Why is this? And forgive my pen there. Why is this? Well, depreciation, if we get into the depths, is something that is controllable by the organisation, and they can subsequently adjust their depreciation policy, if they so desire, to massage their taxable profits. And as such, the HMRC have set some rules that must be followed by all companies. And this is in complete disregard of what has already been submitted in their financial statements. Companies are free to choose the depreciation policy they like, but when it comes to calculating the tax payable, the depreciation should be added back, and in its place, we have to deduct the capital allowances, which, as you know, are in accordance with the rules that are allowable. So appreciate if it mentions depreciation, it's not an allowable expense. It's replaced, we won't go into the full detail here, by the capital allowances. These items are allowed instead of depreciation, and you may see this written down as your tax allowable depreciation. So take on board the examiner's feedback, make sure you don't fall into those errors. Now, this corporation tax return is a legal requirement, and it must be submitted by the due deadline. So it is a legal requirement. All firms must complete, and it determines the tax payable for the year, and subsequently there are strict deadlines and strict rules that must be adhered to, and failure to do this could result in a fine. So you've got a broad picture. Let's get to the specifics of this question, and as I stress, each task 4 is different. This is representative of what you could be facing, but it's not indicative. You could be facing a broader range of items. So please don't think that because we don't see depreciation, for instance, or private use in this task, that you won't face it. They are the ones that the examiner says you, the student community, often make errors with. Let's come across, shall we? Let's go back to the task in hand. So what are we given in this requirement? We are given turnover. Now, turnover perhaps is slightly misleading. It's not taxable. That is our income, our revenue. What we really will pay tax on is our trading profits. This figure here, the 500,350. But nonetheless, as you can see, we are asked in box 145 to complete the total turnover from trade. So subsequently, in this box, we will place 1400250. The company has generated £1,400,250, which we have to inform because it represents and indicates as to whether or not our profitability is accurate. Now, the next thing that we have here, so let me just tick that we've dealt. We're asked in this return, and banks, building society, insurance companies, other financial concerns, put an X in this box if you have recognised turnover and have not made an entry. Well, no, that doesn't apply in this situation here. There is no mention that this business falls into that category. So guys, what you would just do in this situation is you would leave it blank. It does not need to be completed. We continue and we now have trade-in profits. So here I'm going to place our 500,350. Here's our first situation that we must deal with. Because in box 160, the trading losses brought forward and claimed against profits. Now I'm sure you guys are strong here, but let's just return to basics, shall we? Trading losses. Well, these are an allowable deduction, but we can offset against total taxable profit in the year that this arises. Now this is an important distinction because as you can see, we have other income, rental and chargeable gains. And as you will hopefully have recognized just here, the taxable loss brought forward is greater than the trading profits that we generated in this year. Now, does that mean that we must subsequently deduct the whole 650 and offset against some of these items down here? Well, that's why you need to know the loss rules. And as I've said, well, if this was in the year, we could offset against our total taxable profit. However, any trading losses carried forward, can only be offset against our trading profit. So any trading losses, guys, what that means is we cannot use a penny more than the 500,350. And so the trading loss carried forward was 650,250. The trading profit for the 31st of the 12th, 2016 was 500,350, which means that we have further trading losses to carry forward of 149,900, and that, guys, will be used in the financial year end 31st of the 12th, 2017. Okay, we cannot use a penny more. So coming back to the computation, what we now will do is we will just use that 500,350, and the net trading profits in this instance is 0 because we have subsequently offset all of our trading losses, trading profits, with that significant trading loss carried forward. Now, that's the hurdle that you really had to overcome. Bank, building society, or other interest and profits from non-trading loan relationships, there doesn't appear to be any there. So we just leave that 170 blank. Put an X in box 172 if the figure in box 170 is net of carrying back a deficit from a later accounting period. Quite a significant mouthful, but guys, we haven't put anything into box 170, so we needn't concern ourselves with box 172. Box 175, annual payments not otherwise charged to corporation tax, and from which income tax has not been deducted. Well, I can't seem to see anything there that relates to that either. So our income is, or these boxes I should say, are left clear, with no need to make any attachment whatsoever. Just looking at that question there from Wayne. I don't know if that relates to me, Wayne. Now, non-exempt dividends or distributions from non-UK resident companies, there was none. Income from which income tax has been deducted, there was none. But here, in 190, we have a property business income, which the requirement does mention. Let's take you back up to the top. We are told that there is net rental income of 85,750. Well, that's exactly where we're going to place this. The property business, that 85,750 is placed in this box. Non-trading gains from intangible fixed assets, tonnage tax profits, income not falling under any other heading. Well, I don't see any of those items referred to in our information, so we can move on. Chargeable gains. Now, here we go. Gross chargeable gains, losses included, brought forward, net chargeable gains. Well, there was a chargeable gain. There was a chargeable gain of 28,890. And that's exactly what I'm going to put in this box just here. 28,890. Allowable losses included losses brought forward. Well, the loss that we had was a trading loss, and subsequently there was, we have, I should say, dealt with that. So there was nil, which means the net chargeable gain is 28,890. Gosh, we're moving rapidly through this now. Losses brought forward against certain investment income. Losses brought forward against certain investment income. I didn't see anything in the requirement. Non-trading deficit on loan relationships, including interest and derivative contracts, brought forward. I don't recall any of that either. Now, we come to the very last box. And I want to make sure that we have got this accurate. So what I do prior to filling that box in is do my own little reconciliation, taking you back to where we were at the start. So I'll do this alongside. Our trading income, if you recall, is nil. Our interest income, in this particular requirement, there was none. And if you're wondering why the trading income is nil, it's because we had 500 and 350 deducting the 500 and 350, subsequently bringing us down to nil. Interest income. Well, the interest income we had was also nil. We had rental income of 85,750. Chargeable gains we declared to be 28,890, giving us a subtotal of 114,640. In this particular scenario, there is no mention of any tax deductible charitable donations, so our total taxable profits should be 114,640. That nice, neat little summary that we have done subsequently enables us to reconcile with the task in hand. And therefore, when we come back to the task in hand, I have nothing placed in boxes 225 or 230, but I'm now being asked to find the net sum of boxes 165 to 205 and 220 minus the sum of boxes 225 and 230. Well, 225, there was no entrance. 230, there was no entrance. What happened in 220? There was a figure in 220 of 28,890. And what happened in 165 to 205, the net sum, well, 165 was a 0. 205, there's an 85750. So that's all I have, is the sum 85, I've lost that number, 750. So the sum of those boxes and 220 minus the sum of boxes 225, well guys, that comes exactly back to our 114640. So you can take a sigh of relief, should I say, in that we have managed to place those numbers in with accuracy. Let's refresh what we've done in this task. Let's not be complacent. We were given a simple requirement in this regard with 5 numbers, and we had to use our awareness of where precisely to place these numbers within the extract of the corporation tax return. We started off by simply placing the turnover in the turnover box. We then dealt with these two figures here as a separate working, recognizing our awareness of the loss relief rules to see that the profits generated were entirely offset by partial losses brought forward. Remember, 150,000 of those losses will subsequently carry forward into a future corporation tax year. So our net trading profits came to 0. There was no other numbers to place in any of these boxes until we came to box number 190, where we placed the income from our property business of 85,750. Again, there was no further details on any of the boxes from 195 down to 205. And then we arrived at the chargeable gains, where we placed a 28,890 into box 210 because that was the relevant gross chargeable gains. The allowable losses were not mentioned, hence we assumed them to be 0, and our net chargeable gains was simply the sum of those two. We then got to profit before deductions and relief. We had no losses brought forward from investment income and no non-trade deficits on loan relationships or derivative contracts, and thus we arrived at this reconcilable figure of 114,640. Guys, it's a lovely task, but as I stress, you mustn't make the errors that many people do. So just to warn you of them in closing, the examiner tells us to be aware of a private use adjustment. A private use adjustment will be clearly labelled for us. It would indicate the percentage that the individual has utilised for their own accord, and you would subsequently take that percentage away from the allowable expenses. Remember, the examiner warns you that depreciation should not be included in the corporation tax return. It is not an allowable expense, because of the reason that a company can massage that figure, not claiming they're doing it deliberately, but it's not within the HMRC's control, and they could end up doing such that it would lead to less tax being paid. So, in its place, there are rules and regulations that we follow. Capital allowances. And as you know from your studies, the special pause and all of those exciting things that you have to deal with are a separate task in itself. But depreciation is replaced by capital allowances, and this corporation tax return is so vital. Guys, that is a wonderful task, and I look forward to seeing you in business tax once again. So, in conclusion, have I got the right button? There we go. Make sure in your studies that you are aware of more than just the boxes that we have subsequently looked at in this session today. Make sure that each and every box is recognizable to you. Ensure that you are aware in advance rather than taking a hazardous guess of the information that must be placed upon them. Make sure that you are comfortable with any adjustments, such as the losses and the personal use and the depreciation that could invariably come your way. I hope you found this useful and guiding you towards success in your business tax exam. Stay tuned, because I'll be back in the next exciting session, and this time, for those of you that are interested, I'll be looking at personal tax. But until then, folks, study hard, stay focused, and you will succeed. Thank you from all of us at LSBF TV. Goodbye.